Good evening, everyone. Thank you for joining us today. This webinar is put on by the Arizona Medical Association, your professional association. My name is Shelby Jobe, and I serve as the Director of Communications here at ArMA. And so without further ado, let us turn to our presentation, which is part of ArMA's effort to equip you with the tools you need to thrive as a physician or physician in training in Arizona. Tonight, we're proud to feature one of ArMA's valued allies in medicine, WestPac Wealth Partners. WestPac is a privately held wealth management firm founded with the intent to assist their clients in every aspect of their financial lives. Joining us tonight to represent WestPac is Joshua Brown, financial advisor and certified financial planner. Josh is one of WestPac's team members dedicated to serving ArMA's members, and it is an honor to briefly introduce him to you. In his work, Josh primarily works with privately held businesses, medical professionals, and business executives in the areas of insurance, investment, tax, and estate planning. As a certified financial planner, Josh stays current in today's complex financial market, and he delivers insight that inspires clients with the confidence and clarity that they need to make smart financial decisions. So with that, I am pleased to turn tonight's presentation over to Josh.
Shelby, thank you so much for that introduction. Just fantastic. Very excited to be with you all today. Thank you all after a long days of work and signing in and hopefully getting some value out of today's presentation. Shelby hit the nail on the head as far as, what we are hoping to do, our vision, our mission to engage with all the members over at Arizona Medical Association and provide products, solutions, and consult in some of these more complex areas. I have the pleasure of bringing on Adam Johnson, one of our partners, in some of the aspects of the retirement plan design on the call today, who's also going to speak to a lot of what's going on here on the retirement side. I think this is so timely given all the recent law that's passed and just getting this more or less on everyone's radar. And being aware of what's going on. So with that being said, I'm going to let Adam take over here. And once again, thank you all for signing on.
Hey, thanks, Josh, for the introduction. And thanks for your time tonight, folks. We're going to try to keep this concise. We're going to try to keep it very timely in terms of what you need to know from your perspective as a physician or as a physician's assistant, and really trying to identify where the opportunity lies for your organization to have the right plan and the right solution given some of the changes that are happening. And so at the end of the day, what we're really going to focus on here is we're going to take a look at some of the things that happen as a result of this recent legislation. We're going to talk about why the legislation was passed in the first place. So Secure 2.0 was something that was passed in December of 2022. It has some effects on 2023. It has some additional effects on 2024 and future tax years. And so we're going to talk about the why they did that. We're going to talk about some of the provisions. Now, just disclaimer, there are 92 provisions. I promise we are not going to cover all 92 provisions in this webinar. But we've really tried to think about what are the things that matter most to you all, and what are the things that you need to be thinking about, whether you've already got a plan in place or whether you're thinking about starting a retirement plan for your practice, really thinking about some of the things that are inherent in this legislation and making sure that you're prepared to understand what is facing you and what the opportunity is, and of course, what some of the changes are that you'll have to deal with. So as you look through the agenda, we're going to talk a little bit about the why, which is expanding coverage and increasing savings opportunities for employees. We're going to really talk about some of the pay for provisions, which is really what the government has done to pay for this legislation, is to really radically expand Roth. We're going to take a look at some of the different ideas that they have to expand upon plan design and increase access for participants. And of course, we're going to talk about some of the financial incentives that are available for you as a small business owner as you look at really taking on and trying to target. As Shelby already said, you certainly have access to the chat window, so you can type in questions in the Q&A section. We will try to generally hold most of those questions until the end, and we will certainly make time for that. But the goal is for us to sort of work through some of the details and then make sure that we have an opportunity to answer those specific questions that you might have. Keep in mind as well that we'll have the ability to reach Josh or myself as a follow-up to this webinar and talk about any very specific things. So the first thing that I want to talk about is really the why. And when I think about this legislation, there's been a number of different bills that have been introduced over time. For those of us in Arizona, which again, the majority of us are, since we're in the Arizona Medical Association, the state of Arizona has not yet mandated that we have retirement plan coverage, but many of our states on our borders and many of the states around the country have done so. And really what Congress was worried about when they were looking at this Secure 2.0 Act was they really wanted an opportunity for more employees to save for retirement through a workplace retirement plan. The stat that they consistently come back to, and this is true when you look at the information that was put out by a lot of the members of Congress, the information that was put out by the different political organizations, is that employees are 9 times more likely to save for retirement if they have an automatic retirement savings vehicle through their workplace. So if it can be a payroll deduction, they are 9 times more likely than they would be to just simply go out and find their own financial advisor or find their own platform and open up an individual retirement account. And, ultimately, there was various versions of this bill that were passed. As you can see on the screen here, the ultimate version was signed into law on December 29th of 2022. But there was a previous version of this bill that was introduced in the House and passed in March of 2022 by a vote of 414 to 5. Now, I don't know what you think about, but when I think about anything that passes the House 414 to 5, I recognize that there is significant bipartisan support. And essentially what they're saying is we need to have access for employees to be able to save at work. We need to provide incentives for small business owners to start retirement plans. Because ultimately where the challenge often lies is that there is not only complexity, but there is cost associated with starting a retirement plan. And so there is a significant number of incentives that are created for small business owners to create a retirement plan as part of this. And there are also a number of what we call pay for provisions in order to offset some of the costs associated with those incentives. And so we're going to talk first about the incentives, and then we're going to talk a little bit about the pay for. Now, one of the things that I've realized is the more and more of these presentations that I've done is when you talk about 92 different individual provisions, one of the challenges is that it says, section 101 means this, and section 102 means this, and section 103 means this. And while numerically you can kind of follow along in your head, the timeline of those sections and when they become effective has really been changed as they've gotten the bill to a place where it can pass. And ultimately, when the bill did pass in December of 2022, it was part of an appropriations bill. So it wasn't a standalone bill. It no longer passed 414 to 5. It passed 225 to 201. So it still passed. But the reason I say that is because there's a lot of wrangling, a lot of things that happen. And so one of the things that I'm going to do is I'm actually going to talk about this bill in terms of when these provisions become effective. Because I know from my perspective, first we can talk about the provisions and the when, what's effective right now in 2023, what is going to be effective in 2024, and then what provisions are effective in 2025 and beyond. It's far easier to digest. What do I need to think about as a small business owner today? And so I'm going to jump over to this other section here where we actually dig into, and I'm just going to hit full screen mode here, but we're basically going to dig in and we're going to look first at the provisions of this bill that are actually effective right now. So the first bullet point item that we have is section 102, which is at the very top of the screen here, is a significantly larger credit for small business owners who are starting a retirement plan. So there is a number of different caveats to this provision, but essentially what they consistently heard when they polled small business owners about why do you not offer a retirement plan to your employees, the number one reason that was often cited was cost. And so what these business owners and what essentially Congress did was to say, what can we do to take cost off the table? So there was a previous version of Secure 1.0 is what it's often called. But basically, it offered up to 50% of your credit or of your cost associated with starting a plan, up to $5,000 in out-of-pocket costs. So if you had to generate, costs of $5,000 associated with, running and setting up a retirement plan, whether that's a plan document fee or an annual administration fee or any sort of out-of-pocket cost for you as the business owner, Secure 1.0, the previous version of this legislation, basically said we'll pay up to 50% of that cost. What they realized is that for a lot of small business owners, that may not have been enough. And so what this bill does is it essentially says for anybody who's a small business owner with 50 or fewer employees, the credit now is up to 100% of the first $5,000 worth of administrative costs that you may pay in order to establish a retirement plan. And so you may know that, Josh and I run a retirement plan that's supported by ArMA, and essentially that plan has certain out-of-pocket costs for brand new companies that establish a plan. Those costs up to $5,000 can be covered by this tax credit if you, in fact, establish the plan and have to pay those costs out of pocket up to 50 employees. If you're still a small business, but you have from 50 to 100 employees, you can still get that old credit, which is 50% of the administrative costs up to the first $5,000. However, Secure 2.0 also added this additional line to Section 102, which is an additional credit. So that additional credit essentially not only pays for the administrative costs associated with having a plan, but it also pays for a percentage of the employer contributions associated with a plan. And so what do I mean by that? If you have, let's say, for example, 20 or 30 employees on your staff, not only can you have up to 100% of your administrative costs associated with running the plan, filing the 5500, doing the plan documents, having the plan operational, but you can also get up to $1,000 per employee per year in terms of your matching contributions. So you may know that typically when you have a retirement plan, you have a 401k plan, you often offer a matching contribution to those employees who decide to contribute. Up to $1,000 per employee can be given back in the first year. You get $1,000 in the second year. You get $750 in the third year, $500 in the fourth year, and $250 in the fifth year. And so essentially what the government is saying is not only are we going to pay for you to establish a plan so that you can cover your employees, but also we're going to pay for a significant portion of the matching costs associated with having that plan and making a match available to your employees. That money can be used towards a match. It can also be used towards a profit sharing contribution. And so essentially what the government is saying is we not only want you to establish a plan, but we're going to essentially offset a large percentage of the costs associated with not only running the plan, but also providing a matching contribution. And we're going to stretch that credit out over potentially 5 years. Now, of course, whenever they make any sort of large tax incentive like we have, we also have pay for provisions. And so I'm going to talk about a little bit of this, but what you're going to see is there is a significant number of Roth contributions or Roth provisions that are in this legislation. And so as I said, I've sort of organized this in terms of what's effective now, what will be effective next year, and then what will be effective in future years. And that's what we'll be covering in the next, 25 or so minutes. But essentially, Congress really understands that people are living longer. So you see Section 107 here. Required minimum distributions have in 2023 been extended by 1 year. So you may know that for many, many years, you had to start taking distributions from your retirement account when you were 70 and a half, or the year that you turned 70 and a half. The previous version, Secure 1.0 of this bill, moved that number to age 72. This particular legislation moved that to age 73, but you can see that it's further increased to 75 in 2033. And I just want to make an important point, which I will come back to as we continue to talk about this. The reason why they chose the year 2033. So the way that the government scores the costs for bills like this is they look at costs that are incurred by the government in the first 10 years after the bill is passed. After 10 years, any costs associated with the bill are not in what's called the scoring window. And so if they continue to allow minimum or amounts to grow inside retirement plans, and they don't require minimum distributions until 2033, then extending out that window before you have to take money out of your retirement plan doesn't count against the bill, doesn't count as a cost. So they were able to move it by 1 year now. And in 10 years, they were able to push it out 2 more additional years where you don't have to take minimum distribution. So for those of you who are well under the age of 70, 72, 73, 75, right now, the way the legislation reads, you won't have to begin taking distributions from your 401k or from your IRA contribution until the age of 75. And obviously, if someone's in between and they're 73 by 2023, they'll have to start now. Now, the other thing that they did is they included a significant number of Roth features. And remember, I said there's 92 provisions in this bill. We don't have an intention to cover all 92. However, I do think there's a significant number of provisions that actually are related to Roth contributions. And I'll just sort of pause for a second and state, essentially, a Roth contribution allows somebody to make an after-tax contribution to a 401k account, to a IRA, to some sort of individual account, and obviously, essentially what you're able to do is you're able to make that contribution after tax. So you pay the tax on the contribution. That money continues just like it would if it was a pre-tax contribution to grow on a tax-deferred basis. The difference with the Roth is when you take that money back out of the plan, it is a tax-free distribution. Now, something that you may or may not know, but as it relates to retirement plans, regardless of your adjusted gross income, so regardless of your income, you can make Roth contributions to a 401k style retirement plan. So there is no AGI limit on your income. You're able to make those contributions. What the government basically did is not only say, can you as an employee make contributions of your own wages? So in 2023, any employee theoretically can fund $22,500 as an employee deferral into a retirement plan. But they also enacted Section 604 here, which you see, which enables you to essentially, as an employee, designate that you'd like to receive your matching contributions as a Roth. And back to my conversation on the scoring window, essentially what the government is betting on is that they're going to receive some of those tax dollars earlier, and they're going to be able to count those as revenue to offset some of those significant tax incentives that they're making to allow employers to adopt retirement plans. They're also going to allow both simple and SEP plans to accept Roth deferrals or Roth employer SEP contributions. Now, a very important part of this conversation, and the question that I often get, and we may have this question, now, but is if I make a Roth employer contribution to my employees, do I no longer get to deduct that contribution? So what is intended by this is that the employee has the option to receive these monies as they normally would, which would have been on a pre-tax basis. But if the plan allows, they can elect on the employee level to receive it as a Roth contribution. And so what would happen is the company, the business, would still get the deduction, and then the employee would be taxed on it as a contribution to their account. Of course, in order to affect some of these changes, there is some clarification required from the IRS as to, do we issue a 1099 to that employee, or do we report these Roth contributions on their W-2? And as of now, we're still waiting for some of that clarification. But in terms of the bill, the reason why that was included this year in 2023 was because it was essentially counted then as expected revenue to be received by the government this year to offset some of those significant tax credits that are available. I'm not going to go through every one of these provisions, but one of the other provisions that's effective right now that I definitely want to cover is hardship certification. So for those of you who already offer a plan or have been participants in plans in the past, you may know that many plans offer what's called a hardship distribution. So if an employee has a specific financial hardship, they're able to access funds out of the plan. So that could be medical expenses not covered by insurance. It could be amounts needed to prevent their eviction or foreclosure on their home, amounts needed to provide and buy a first home. amounts needed as a casualty loss, a natural disaster on their home, post-secondary education for themselves or their direct dependents. So there's some very specific reasons why you can access what's called a hardship distribution. One of the challenges of the hardship distribution laws is that you have to essentially ensure that employees do in fact qualify for that hardship. Now, there was a number of provisions that were passed as a result of COVID in something called the CARES Act that allowed employees to basically self-certify, hey, I have this situation. Can I please take money out of the retirement plan? And what this provision does here is it allows you as an employer to allow hardship distributions to be self-certified as well. And so essentially what that means is employees are given the list of rules that says, here are the 8 different qualifying criteria for which you can have a hardship distribution. Here are the items that you as the employee need to have on hand to document that you in fact have this hardship distribution. But the employee is able to self-certify that they do meet those criteria, and the employer is no longer obligated to keep a record of all of those specific information or those specific certification documents. So I would just say, from the point of view of an employer, I would much rather have the employee signing off and saying, hey, I've got this hardship, I've got the documentation, I'm good, rather than having that obligation on me. Now, that is a choice. So as an employer, you don't have to allow your employees to self-certify, but you are now allowed to have those employees self-certify. And back to my comments earlier about the scoring window, obviously, the more hardship distributions there are from retirement plans, the more revenue that the IRS is anticipating receiving today. The other thing that I think is really interesting, given some of the more recent things that are happening around the country, is this qualified disaster distribution. They've actually created a specific certification outside of the regular hardship distributions for a qualified disaster. So if there is a federally declared disaster, you can take up to a $22,000 distribution from the plan, and you can essentially exempt yourself from the typical 10% early withdrawal penalty. And as an employee, you can actually spread the tax hit over 3 years and potentially repay those contributions. So if we do have a federally declared disaster here in Arizona, we will be able to essentially have this additional distribution option that allows people to access their retirement plan funds and basically gives them the opportunity to pay tax over time. I'm going to skip some of these other specific provisions that you see, and I'm going to jump right into 2024. So this now is things that are effective for the next tax year that's just about to upcome here. And this next section, I think, is one of the areas that's gotten some of the most attention. So for those of you who are looking at it, you may have heard some different updates on this. But essentially what the IRS is doing is they're requiring that most folks who make significant catch-up contributions do so on a Roth basis. And so essentially what this rule says is that if anybody earned $145,000 or more in 2023, and they want to take advantage of a catch-up contribution, that catch-up contribution must be made on a Roth after-tax basis. So, for example, in a retirement plan, you're allowed this year in 2023 to make a $22,000 500 contribution as a regular employee deferral. If you're over the age of 50, you can make an additional $7,500 contribution. So a total of $30,000 that you can fund into the retirement plan. But basically, when you do that, what they're saying is if you earned more than $145,000 in 2023, then that catch-up contribution must be made on a Roth after-tax basis. You no longer have the choice to do it either on a pre-tax or a Roth after-tax basis. Now, this particular provision got a lot of feedback to the IRS and the Department of Labor because there was a lot of questions about recharacterizing or changing or how do we test this. And so actually what they have now done is they have now delayed this provision until January of 2026. So this was initially in Secure 2.0, effective January 1st of next year. That has been delayed until January 1st of 2026. So I think that's good news for folks who want to make pre-tax contributions. I also think it's good news for those of you who are looking at figuring out the right strategy for how to adopt the provisions in your plan to be able to correctly test and monitor those contributions if you or any of your employees are earning more than $145,000. So that provision is going to be important. It is going to offer a lot more Roth contributions, and which obviously, again, is taxes within the scoring window. The other thing that this provision did, which I think is really important, is it eliminated, if you look at this next one, 325, it actually eliminated required minimum distributions inside Roth 401ks. And so this gets a little bit esoteric. And so I'll just kind of make one comment, which is if you had historically a Roth IRA, there were no required minimum distributions from that Roth IRA. But if the money stayed in a 401k plan and was made on a Roth basis, there was no exemption from the required minimum distributions. So you essentially, as you retired from working for a company, you would have to roll money out of your Roth 401k into a Roth IRA to be able to prevent required minimum distributions. They realized that was a silly rule. And so essentially what they did is they said, hey, we're going to eliminate 401k required minimum distributions for Roth accounts as well, so that you don't have to have that money moving out of the retirement plan into an IRA. Obviously, you still have the ability to move it out to an IRA, but you're not required to do so. So I think that's a really big deal, and it just makes it simpler to administrate. If you have the money still in the 401k plan, you don't have to take RMDs starting in 2024. The next provision here is Section 108, IRA Catch Up contribution. So I mentioned, we have these Roth Catch Up contributions and we have Roth 401ks. And so 2023, the limits are $22,500 for deferrals and $7,500 for 401k catch ups. For whatever reason, the IRA catch up limit has always been $1,000 more than your regular deferral. So they are now going to index that so that potentially IRA catch up contributions will also grow with inflation. So there's two more on this particular page that I really want to highlight. And there are these next sections, 115 and 127. So remember what I started with, which is the reason why the government was so keen on passing this legislation was to provide access to employees to a workplace retirement plan. And when they talked to employers, the number one reason that they didn't offer a retirement plan was due to either complexity or due to cost. And so the goal was really to eliminate some of that cost associated with setting up a retirement plan, not only for the administrative cost, but also for the matching cost. When you talk to employees, the number one reason why they don't always save as much as they should is they're worried about more immediate expenses. And so what these two provisions did is it offered two different ways to allow employees to access their funds in case of financial emergency. So I already talked a little bit about the specified hardship withdrawal reasons, something like amounts needed to prevent your eviction or foreclosure, amounts needed for medical expenses not covered by insurance, or a casualty loss on your home, or for post-secondary education. Those provisions have been around for a long time, but it isn't always qualified for employees to gain access to those funds. And so sometimes what happens is employees forego contributing to a retirement plan because they're worried about these other costs that don't specifically qualify. So what this provision does is it allows employers to have what's called an emergency expense withdrawal. Now, of course, it's important that this amount isn't unlimited. So certainly you can take a far larger contribution, or a far larger distribution should you want to pay for a casualty loss on your home, or should you want to pay for post-secondary education. But this emergency expense withdrawal essentially says that the employee can self-certify that they had an unforeseeable or immediate financial need, and they can take up to one distribution a year of up to $1,000 out of their account. They are exempted from the early withdrawal penalty. If it's a pre-tax distribution, they'll still have to pay tax on that distribution, but they can ultimately receive that $1,000 out of the retirement plan, essentially breaking that barrier to why they may want to save for retirement. The employee can also repay that $1,000 over the next 3 years. And if they have repaid the distribution, they can take another $1,000 distribution. So if they don't repay the $1,000, they have to wait 3 years before taking another one. But if they do repay it, then they can take another distribution within the 3-year period, and they can avoid tax on that distribution. So that is, in my opinion, a very straightforward, easy provision to administer. They also kind of went for the home run, which is the employer created emergency savings account. Essentially, what they're doing is they're linking automatic enrollment in retirement plans with an emergency savings account. And so what they're saying is when employees become eligible for a retirement plan, they're going to enroll them automatically at 3% of salary on a Roth after-tax basis. Again, we got that pay-for provision. And they're going to put 3% of their salary until that employee receives $2,500 in an emergency account. Once that's met, then they're going to automatically enroll them into a Roth 401k, just like any other Roth 401k. And ultimately, they're going to have this sidecar account of $2,500 that's just there for the employee to use at will in order to have funds set aside for any sort of financial emergency. I think this provision is going to be very popular once we can figure out how to properly administer it and really work with the payroll companies to do so, because I believe that employees would much rather be defaulted into a solution that enables them to have access to funds that still help them in case of a water heater blowing up or a child going to the ER or something of that nature, but basically then automatically enrolls them once they have a healthy balance, $2,500 that's set aside for that purpose. The last one I'm going to talk about, and I think this is near and dear to a lot of physicians and a lot of folks who are in your field, the student loan match. So, student loans obviously are a very, very important topic as the debt load for students coming out of college and different professional organizations has grown exponentially over the last few decades. Many young employees would almost rather receive money to help pay down their student loans, or maybe are having trouble saving for retirement because of their student loans. And so there was a company that you may all be familiar with by the name of Abbott Labs. And basically what they did is they submitted for a private letter ruling to the IRS and said, hey, we would like to basically take all of our employees who have student loans, and if they make payments towards their student loans, we would allow that to be counted as if it were a contribution to the retirement plan. And we would like to still make our company matching contribution to those employees, even though they put the money in the student loans and didn't put it in the retirement plan. So what this did is the IRS, number one, granted that, said, Abbott Labs, you can do this for your employees. But it was a private letter ruling, so it did not apply automatically to all employees. And so what ended up happening was a lot of other companies immediately submitted for a new private letter ruling, which the IRS didn't necessarily want to opine on each of these individually. And so in this law, in Secure 2.0, they have now essentially effective next year made this so any employee who makes a qualified student loan payment can receive their company matching contribution, which is also subject to that credit if we decide to use that we talked about before. And essentially, if they use indebtedness incurred by the employee to pay for qualified education expenses, we can treat that as if it was a planned contribution and we can match those employees. Okay. There's a number of other provisions here. Again, I'm gonna, in the interest of time, keep us on track. And I'm going to talk about probably 2 or 3 other provisions before we go to Q&A. And I'll just say, to me, this is probably one of the most important provisions that kind of got snuck in here because of when it's effective. It sort of flew under the radar for a lot of people, but I think it's really, really important to understand. So effective in 2025, there's something called required automatic enrollment. And so it's really, really important that you understand a couple of things. One is if you already had a retirement plan for your business on the day that Joe Biden signed the Secure 2.0 Act. So that was December 29th of 2022. If you already had a plan in place at that time, you are grandfathered from this provision. So you essentially have no change required to your retirement plan. But for any employer who begins a brand new 401k style retirement plan after that bill was signed, so after December 29th of last year, they now are going to require that no later than January 1st of 2025, that plan must have automatic enrollment of their employees. So essentially what it means is employees, if they take no action, are automatically going to start contributing at least 3% of pay. You are allowed to start at up to 10%. So if you wanted to start at 4 or 5 or 8 or whatever, anywhere between 3 and 10, but 3 is the minimum. The maximum is 10%. And then there must be an automatic increase of at least 1% up to at least 10% with a maximum of 15%. And so essentially what it's saying is if you start a plan, you basically need to do automatic enrollment associated with that plan. And so the default option is that employees are in the plan unless they take action to opt out. So we also refer to that as negative election. So for all of the new employers that we're working with today who are just starting a plan for the first time, obviously the good news is you have these fantastic tax credits to pay for the administration of the plan, pay for the matching contributions for the plan. But the other part of it is we really are going to need very soon to comply with this automatic enrollment requirement. And so for most of the new plans that we're setting up now, we're actually just establishing them with automatic enrollment right now. Because even if we don't do automatic enrollment today in 2023 or in 2024 when we establish the plan, when this provision becomes effective, we're going to actually have to go backwards and look at everyone who became eligible in earlier years and automatically enroll them anyway. Now, one of the good news is there's an additional tax credit associated with this. So you get an extra $500 tax credit. So remember I said it's 100% of your administrative costs up to $5,000. You get an additional $500 credit for doing automatic enrollment for 3 years as well. So that obviously is the good news associated with that. But I just think really what the government is doing here is they're making the default answer that people are in the retirement plan unless they say no. One of the things that I would say is that for employers who maybe have had a plan for a number of years, who have not historically had the automatic enrollment provision, we do think that over the next 3 to 5 years, that will become more standard. And it almost may be more of an expectation for the employees that you're automatically enrolled if you don't take action, because every single new plan will already have that provision. Most of the larger employers that exist already have that provision in their plan. And so really it's really just the smaller employers who have historically maybe not had it as often. And we think that as that takes root and as all new plans have to have it, we can foresee that there's going to be a high number of employers that just automatically enroll. So that may be something to talk about, maybe something to consider with your plan, even if you are grandfathered, as to whether you want to adopt automatic enrollment. But again, I think it's really important. If you've already got a plan, if you've had a plan since prior to December 29th of last year, you are not obligated. The other exemption is if you have less than 10 employees or you've only been in business 3 years or less, you can also avoid that automatic enrollment, at least for the first 3 years. So there are some administrative provisions that allow folks to get out of the automatic enrollment if they're a really new business or they're a very small employer group. The last thing that I'll just say, and we'll kind of jump to Q&A after this, but the last thing that I'll talk about is effective a couple years after next year. So 2027, the government is going to enact what they call the Savers Match. So you may or may not know this. There's something called the Savers Credit, which has been around a number of years. Essentially, if you earn more than $71,000 merit filing joint, you're not eligible for the credit, but an employee can receive up to 50% of the first $2,000 they contribute to a retirement plan back as a Savers Credit. So if they pay $2,000 and they earn a low enough income, they can get up to $1,000 back. As their income goes up to 71,000, they get less than half of it back, but they still get a credit for saving for retirement. One of the challenges that's happened with this system is that you can't do the easy file or the free filing and still get the credit. You actually have to provide a little bit longer return. And so, as you may imagine, a number of employees who qualify for the Savers credit simply don't apply for it. So number one, I would say, if we have employees who are earning less than 71,000 married filing joint, then we certainly want to help educate them about the fact that they may be eligible for a Savers credit if they save for retirement. But beyond that, because the system is complex for a lot of those folks who would rather do the free filing, then what the government is essentially doing is saying that is going to transition from a credit that you have to apply for to a Savers match. And so if you earn the right income level and you save for retirement, what they're basically saying is they are going to go ahead and contribute to your retirement plan. And they're going to, instead of crediting that back on your taxes, they're actually going to make a deposit directly into your 401k, directly into your IRA account. So I think that's one of these things that, of course, when the government has to ultimately figure out how to administrate that, they push it off to the very end of the process, to 2027 and beyond. But I do think that for lower income savers, when you think about automatic enrollment, when you think about all these credits associated with, employers starting retirement plans and having access to that, we are going to see more employees automatically saving. We're going to see more employers creating a retirement plan if they historically haven't had one. And we're going to see that more of these employees are ultimately eligible for this Savers match that the government is making on their behalf. And so ultimately, that kind of covers, I would say, the high level provisions that are in the retirement plan bill in Secure 2.0. I know we've got some ability for Q&A. And so I want to make sure we provide, opportunity for questions to be asked. And so, I think what I'll do now is I'll just sort of turn it back and we can see if there's any questions that we want to answer before we end here this evening.
Adam and Josh, thank you. That was a fantastic presentation. And I know that, this type of information can be difficult for individuals to parse through on their own, but you have just really distilled it into some terms that are easy to understand. So we appreciate you taking the time to share it with us. So as you said, we'll turn it over to our attendees. We already have a couple of questions that have rolled in, but as a reminder to everyone, you can submit any questions that you have in the Q&A function, which is at the bottom of your screen. But in the meantime, we'll get kicked off here with our first question, which is a two-part question. It says, is there a requirement to pay back the hardship distributions? What are the rules surrounding that if payback is required?
So great question. First off, there's not a requirement to pay back the hardship distribution. So what has really changed is the government, instead of putting the onus on the employer, which, just so that I'm clear, historically, there's always been an onus on the owner of the business, the trustee of the retirement plan, to verify that an employee, in fact, does qualify for a hardship. That provision now is something where you're able to shift that obligation to the employee who's requesting the funds. So what we've seen as far as best practice is still informing the employee about what qualifies as a hardship distribution, and then informing them about the documentation that they would need to furnish. But by doing it that way, you as the employer are no longer on the hook to collect that information and provide access to it in a retirement plan audit. It is the employee, in fact, that would have to verify that. Now, just to also clarify, there is a emergency expense withdrawal. So this is something that's optional that you can offer to your employees if you choose to put this language in your document. So first and foremost, as an employer, you don't have to offer this provision. But if you do offer that provision, you can allow someone to take up to $1,000 out. There's still no obligation as an emergency expense withdrawal, which is different than a hardship, but now available. And you can allow that person to put money back in up to that $1,000 if they choose to. If they don't put the money back in, there's no obligation. they are then just simply taxed on the $1,000 distribution.
Let's see. We have another question rolling in.
Okay.
In a different topic here, can you help me better understand the available tax credit for companies starting a plan? Specifically, how do I know how much I am eligible to receive? For example, if I have 20 employees, what is the available credit?
So I think there's definitely is going to be something that we do in conjunction with your CPA, because there's a form to file, of course. But in general, if you have 20 employees or more, basically you're eligible to receive the maximum tax credit, which is up to $5,000 of the administrative cost that you use to run the plan. And it does get a little bit nuanced, but specifically what we're looking at is employees who are eligible for the plan. So even if you have 20, we only count the people that you make eligible based on the criteria that you use. And essentially you get up to $5,000 if you have 20 or more. If you have less than 20, you'll still get a significant credit, but it may not be all the way up to $5,000. And if you have between 20 and 50, you kind of qualify for the full $5,000 administrative credit. Now, that other credit that I was talking about, which is towards the match, is really, really important. So you get $1,000 in match per eligible employee who receives match. So let's just say, for example, you offer a match to your 20 employees, but only 5 of them decide to sign up for the plan. For those 5 employees who sign up, you can receive up to $1,000 back towards the contribution that you make into their account. So if you think about kind of your typical match, it's usually like a 4% matching contribution on what employees put in. Let's say you've got an employee who earns, $50,000. If they make a 4% contribution to the plan, they're going to fund $2,000. You're going to match them $2,000, and you're basically going to get $1,000 of that back as a tax credit. So again, there's going to be some details that we have to cover with your CPA to make sure you file the right forms and things. But it's up to $5,000 for your administrative costs, and it's up to $1,000 per person you actually match within your staff.
Okay, and let's see, we have 2 more questions here in the lineup. And so someone has asked, do I have to use Roth for my catch up in 2023?
So that provision, no. And actually it's been extended now till 2026. So if you make a catch-up contribution in 2023, 2024, or 2025, the previous rules still apply. You can make it either on a pre-tax or on a Roth basis. Starting now in 2026, because this has been extended after the act was initially passed, if you earned more than $145,000 in the previous year. So they're going to look at what your actual income was in 2025. If that number was more than $145,000, any catch-up contributions you make will have to be done on a Roth basis in 2026. That'll be the first year that is now effective. Again, initially it was earlier. It got delayed because there was so much kind of pushback and questions to how to administer it. The IRS issued a ruling to essentially delay the effective date of that provision until 1/1 of 2026.
And then we'll go ahead and round out with our last question here. If I already have a plan, am I required to do automatic enrollment of my employees?
So if you, and specifically the dates matter. And of course, they always make this as complex as they can. But really the question is, did your plan have a 401k provision in it on December 29th of 2022? So that was the day that Biden actually signed this into law. If you had a plan on that date, you are grandfathered and you do not need to have automatic enrollment in your plan. You can choose to, but it's not required. If you establish a new 401k provision, whether you just had a profit sharing plan, you're adding 401k, or whether you're adding a whole new plan that never existed before, if you as an employer, you're starting a plan after December 29th of 2022, then you will need to have automatic enrollment as a provision in your plan.
Okay. Well, that brings us to the end of our Q&A. Adam and Josh, thank you again so much for taking the time to speak with us tonight about this, a pressing topic really for physicians who are owning their own practice. For our attendees, I have put some links in the chat there, a link to WestPac's landing page, which gives you a great summary of all the services they offer, including something that we've just rolled out, which is a 401k plan that is available to ArMA members. And so to learn more about that, I highly encourage you to schedule a consultation with Josh and his team, whether you're interested in adding a 401k plan or changing your 401k plan or a number of other financial services. I know that they would love to give you a consultation. We will be sending out a link to the recording of tonight's webinar so that you can rewatch it. But I hope everyone has a good evening in the meantime. And thank you again for taking the time to be with us tonight. Thank you.